What's up, everyone? It's Scotty with MoneyVest. So let's talk about Target. And Target just cannot seem to catch a break. It just keeps on selling off. It is quite down considerably from its all-time highs, and that's exactly what we're here to discuss, and whether this company is now a buying opportunity or not. I'm going to run through an entire fundamental and technical analysis. The company is going to be reporting earnings later this week, so hope you guys enjoy this video and find it helpful. If you do, please make sure that you drop a like, and definitely do consider subscribing. We talk a lot about fundamental analysis, technical analysis, macroeconomics, options, personal finance, everything related to money, so everything's going to be included, and we'd love to have you on board. And don't forget that we do have our Patreon and our Discord link down in the description below and in the pinned comment as well, and you get access to members only private videos. There's over 40 plus lectures and tutorials and members only videos on Patreon, and of course you get access to our Excel spreadsheets and Discord channels, over 20 plus, including trade ideas, trade alerts, and market discussions and market updates as well. So link's going to be down below, and we'd love to have you on board. If you have any questions, please feel free to reach out. So this right here is Target, and Target, as we know, is one of the biggest retailers in North America, along with the likes of Amazon, of course, and we've also got Walmart. I will be doing an analysis on that company later today as well, because they're also reporting their earnings this week. It's a pretty big retail week, but if you take a look at Target, revenues have grown from 71 billion to over 107 billion dollars. So the growth hasn't been like super strong. I mean, it's still reasonable. It's still decent. I mean, for the longest time, you'll notice it was kind of flat. The last 3 years have really, when it's picked up a little bit, as you can see, the last 3 years we've been growing a little bit better. And gross profit has gone from like $21.2 billion to a little bit over $28 billion. And it kind of peaked in 2022. And then since, of course, 2023, we were a little bit lower. And trailing 12 months, we are once again kind of accelerating back higher. Operating income has also been a little bit back and forth. So $4.8 billion, again, peaked in 2022, and then now, of course, a significant decline in 2023, and on a trailing 12-month basis, once again re-accelerating, but nowhere near close to the peak of 2022. Now, for Target, there was a significant amount of mismanagement when it comes to inventory, right? Inventory was over-ordered, double, triple ordered, as we know, and the company was struggling, kind of with that inventory management, and they actually ended up with a lot of inventory, giving huge discounts, and as the consumers kind of shifted from, higher margin electronics over to groceries and some of the more necessity items as well, because of higher interest rates and lower spending, that has completely kind of disrupted the overall margin contributions from Target's business model, and also not to mention the excessive amount of inventory that's sitting on the balance sheet for the company as well. So bottom line also has been struggling. So it's gone from like $1.9 billion to $7 billion, which again was the peak in 2022, and then the last couple of years have been consistent declines. Shares outstanding have been going down, so that's actually phenomenal. So they've gone from 641 million to now sitting at just under 500 million shares outstanding. And EBITDA has also been growing from 6.8 billion to well over 7.5, but it's more or less been moderated now over the last couple of years. Once again, in 2022, that was a peak year for Target at well over $11.7 billion. This right here is going to be the earnings expectations. So $1.47, $1.50, anything under $1.50 is what the expectations are. 27 downgrades. So pretty much all analysts have downgraded this stock from an EPS revision standpoint in the last 90 days, and revenue expectations at just over $25 billion. Margins, I would say, are quite reasonable with the 26% gross margins. We're looking at a net margins of just over 3%, so really, really low. And that, again, is lower than the 5-year average of 4.38%. Return on common equity is pretty good. Return on common assets and total capital is also decent. It's not terrible, but it's also not like super, super great, right? I mean, anything under 7 to 8% is okay, right? I mean, ideally, I'd like to see this number to be much, much higher. And another efficiency metric that I like to focus on is net income per employee and profit per employee, or revenue per employee. 5-year average, $10,000, and now that's come down to under $8,000, meaning the company is now generating less in net profit per employee, meaning that the employees are either not as efficient as before, or the company is not able to allocate resources as well as before, because efficiency is dropping for the company at the moment. Now, to top it all off, the balance sheet is also not great. $1.6 billion of cash and almost $20 billion of debt, which gives the company a positive net debt of $17.6 billion with a current ratio of 0.83. And take a look at this. This is where the problem lies for Target. This is the biggest problem. Quick ratio. Quick ratio is basically current assets minus inventory divided by current liabilities. So the fact that this number is 0.08 basically means the company has and excuse my language here, a shit ton of inventory. Because when you take inventory out, they really don't have any current assets. They literally have no current assets relative to their current liabilities. And even if you take inventory included, even then, they don't have enough current assets to cover their current liabilities. So the balance sheet, short-term, balance sheet situation is really bad. And if you take a look at debt to free cash flow, we're looking at this huge negative number because I'm assuming they've got a lot of negative cash flows as well. So if you come over to the earnings expectations, they're expected to still grow in the mid-singles to low double digits over the next several years, from $7.56 to over $18. So if you plug in those numbers, $7.56 to over $18 here by 2033, we're looking at a growth rate of just over 9% for Target's earnings on the bottom line over the next 10 years. This right here is going to be the revenue forecast. Again, very, very small, modest, low single-digit growth here in revenues. And valuation-wise, because of how much the stock price is down. So if you come over to how much it's been selling off, from 255, the stock is down over 57, almost 60%. It's not a surprise that the valuation has also compressed significantly to 14, 15 times earnings. Price to sales trading at now under 0.5, price to cash flow under 7, and enterprise value to EBITDA also sitting at just over 8 or a little bit under 9 right now. So valuations come down significantly, and this was just more recently from last week. Target CEO says shoppers are pulling back even on groceries as well, and this again is not a great sort of headline. So CEO Brian Cornell says shoppers are pulling back even on groceries as they feel stressed about their budgets. In an interview with CNBC, CEO said and emphasized that the retailer has posted 7 consecutive quarters of declining sales of discretionary items such as apparel and toys in terms of both dollars and units. And again, we talked about this double, triple ordering out of inventory. So inventory levels are really high and the consumer spending has completely shifted away from these discretionary items over to groceries and more necessities. And now even that category is struggling. And he says, and I quote, even in the food and beverage categories over the last few quarters, the units, the number of items they're buying has been declining, which obviously is not great. With the comments, Target doubled down on a cautious outlook as it gears up for the crucial holiday season, and the retailer cut its full-year sales and profit expectations in August, despite a growing number of economists delaying or scrapping calls for a recession, and the government data showing that inflation is also cooling, and the company is reporting earnings on November 15th as well. He further goes on by saying, and I quote, "We've taken a much more conservative approach in planning inventory this year, but we're going to lean into those big seasonal moments and play to win when we know the consumer is looking for something that's new, looking for affordability, and looking for that special item for the holiday season." And over the past few years, Cornell said shoppers have typically sprung for more purchases during seasonal moments, such as Halloween or Mother's Day, a factor that could help in the coming months for the business as well. So, if we assume, let's say the net income for this year for Target, is going to be, let's say, $4 billion. If you assume a very safe, conservative estimate of $4 billion in actual net income. So we plug that number in for Target, and a growth rate, obviously, which is going to be quite low. We're not expecting a lot of growth here. So let's just assume, 8% growth here for Target, and a PE multiple. Right now it's trading at, I believe 14 is what we looked at for the price to earnings multiple for Target. So 14, 15 is where it's at. So if you assume for a similar 14 times earnings multiple, I don't think the company pays, I think it's a very small dividend, actually 4%. So Target now, 4% dividend yield is actually quite good. So we can assume an 8% discount rate, 10% margin of safety, and a negative point, I think 1% is pretty good for share dilution. We're looking at about $114 in intrinsic value, and right now it's trading at about $108. And this makes a lot of sense, right? Because it's down almost 60% from its all-time highs. And there is still expectations for some reasonable growth. However, I will account for a little bit higher margin of safety. I will probably go with 20 or 30% for this business. And the reason for that is simply because of the balance sheet. The balance sheet's not great. They've got a lot of debt with little to no cash, and short-term liquidity is also a big problem because, as I said earlier, their current and quick ratio is really, really bad. I mean, quick ratio is 0.18, current ratio is 0.83 because they've got a lot of inventory on the balance sheet, right? So if you come over to the balance sheet here, total assets, current assets here, we're looking at total inventories of $12.6 billion. $12.6 billion, and their total current assets are $16 billion. So 12 divided by 16, 75%. 75% of their current assets are all in inventory, right? That is a pretty substantial number, and you can see how quickly it's jumped from 2016. It was at 8.3 billion, and that's gone up to over 13.5 as of 2022. So those are, again, pretty sizable numbers here. 75% of their inventory, of their assets are going to be in inventory. And this right here is going to be the overall technical analysis. So, a couple bear flags. So what we have noticed is, of course, selling pressure here, lots of consolidation here, and then another breakdown, consolidation here, then another breakdown, consolidation, and then another breakdown. So it just cannot catch a break from those bear flags. And I think the pandemic lows and $84, $85 would be a quite reasonable level to watch for Target. Not sure if it's ever going to get down there, because that is going to require another 22% decline. But that's a level where I would feel somewhat comfortable after accounting for maybe, let's say, even a 30% margin of safety, and that would put us down under $90 for the intrinsic value for Target. And the reason, again, for the margin of safety here is because of the state of the balance sheet for the company, right? And this is going to be that sensitivity grade. So if you're assuming for a lower growth rate, let's say 6%, with the same 14 times price earnings multiple, we're looking at an $81.33 intrinsic value for this business, versus 8% and 14 is going to be just sub $90 for this company. So hope you guys enjoyed this video. Let me know your thoughts down in the comment section below for Target. Again, earnings are coming out tomorrow. Resistance is going to be all the way up to $120, although there might be an intermediate resistance sitting right over here at 113, 114, and there might also be an intermediate support sitting at about low 100s, so $103 is going to be that support. That's exactly where we bounced off of in the first week of October, but in case we get a breakdown below this, got to be ready for sub 90. That's going to be the pandemic lows for Target moving forward. So I hope you guys enjoyed this video, found it helpful. Make sure that you drop a like. Don't forget to subscribe, and also join our Discord, Patreon. Link's going to be down below to unlock over 40 plus videos and lectures for members only. These are private videos, ad-free, and you get access to Excel spreadsheets and the Discord channels as well. So as always, happy investing, and I will see you all in the next video. Take care.